Got the analysis on Bitmine Immersion Technologies, BMNR. It's about that nearly 20% surge to 3110, driven by its massive ETH treasury and, frankly, surprising EPS forecast.
The core argument is strong. It's just, with a move that big, the structure of the argument has to be airtight. So let's jump right in.
Let's do it. Our first point is really about clarifying the quality of earnings in the valuation. So, to maximize the integrity of the valuation argument, the analysis must more explicitly separate operating income from asset revaluation-driven EPS.
Right. The report kicks off with a stunning trailing PE of 1.94.
And it rightly calls it incredibly low for a high-growth tech stock. I mean, that's the kind of number that gets immediate attention.
It really is. A massive headline that just screams by.
It does. But then the material, it immediately qualifies this. It says the earnings are largely because the earnings are driven by asset revaluation.
And that's the problem. That qualification, while it's intellectually honest, it risks creating this significant cognitive disconnect for the reader.
How so?
Well, you see a PE that suggests the stock is, ridiculously cheap, but then you immediately have to accept that the earnings fueling it are from unrealized gains. They aren't sustainable cash flow.
Right. So if the reader gets hung up on that qualification,
The whole thesis could just collapse into a speculative trade instead of a real investment. That's the risk.
that is the weakness here. We're fundamentally looking at two different businesses inside one stock. You've got the asset manager with the ETH treasury, and then you have the actual tech infrastructure business.
And the argument gets fuzzy if you don't draw a really clear line between them.
You have to show the reader what they're getting from the, let's call it, the stable side of the house. The material needs to show that even if ETH went nowhere, there's still a justifiable, conservative floor value for BMNR based purely on its operations.
Otherwise, that 1.94 PE, it just looks like an accounting fluke, a huge one.
So the suggestion is to bolster the argument by clearly delineating the valuation. Sustainable core ops on one side, leveraged asset treasury on the other.
Show two distinct pathways to value. It shifts the perception of BMNR from just a crypto play to something more like a sophisticated holding company.
That's the key. So what are some concrete examples? How can they actually do that in the report?
Well, the material already has the positive free cash flow number, the $1.84 million.
Right. So instead of just relying on the reported EPS, which we know is skewed,
Calculate a hypothetical PE based purely on that free cash flow. Call it an FCF PE or something.
that's a powerful move. If you can show that the FCFPE is, say, 15,
Then you've instantly framed the core business as trading at a defensible metric. You've established a fundamental floor price right there.
exactly. Or another option, you could provide a normalized operating margin that just strips out all the unrealized gains. Show the health of the non-treasury side of the business.
And then the whole ETH treasury just becomes this massive leveraged upside on top of a stable foundation. You move the conversation away from whether the 1.94 PE is real.
Okay, so once we've established that floor value, we need to address the market context, which brings us to our second point. The claim that BMNR is undervalued relative to its peers must be explicitly supported by comparative data.
The material states pretty confidently that the stock is arguably undervalued compared to its peers, which is a vital claim to make, especially after a 19% pop in one day.
It's a huge claim, but the weakness is it's just a claim. The analysis lists BMNR's metrics, PE of 1.94, price to book of 23.03, but then nothing else.
Right, no competitor data points at all.
Zero. And you just can't make a relative valuation claim without the relative part.
Look, I get it. The audience is probably deep in this sector. They might know what Riot or Marathon trade at.
But you can't rely on that. It's a missed opportunity to reinforce conviction right there, in the moment. If you say it's undervalued, you have to show the comparison immediately.
It's a difference between giving a strong metric and making a strong argument, right?
Exactly. You're making the reader do the homework. The suggestion is simple. Integrate a specific peer comparison point. Just one or two would do it.
So let's talk about which metric, though. Because BMNR is trying to frame itself as an institutional holding company, not just a miner.
That's a fantastic point, and it needs more airtime in the report itself. If their value is increasingly tied to the 3.6 million ETH on a balance sheet.
Which is an asset pool.
Precisely. So we should pick a metric that emphasizes asset valuation, not operational flow.
Which makes price to book, PB, a much more powerful tool here than a traditional PE. It's perfect for their new identity.
It aligns perfectly. So the suggestion is to take that PB ratio and put a peer data point right next to it. Something short and sharp.
Like what?
Like, for context, Peer a comparable firm emphasizing balance sheet assets, currently operates at a 35 PB. Something just like that.
And that one sentence is the silver bullet. It instantly makes the argument persuasive because it grounds the thesis in market reality.
It moves the claim from, I think this is undervalued, to the data shows we're getting a discount on the assets. It's a huge shift.
It is. Okay, that's clear.
So let's pivot to the conclusion. This is critical, especially with that big question hanging over the piece. Is it too late to buy? Our third critique is about structuring the investment strategy to acknowledge that extreme volatility.
The analysis is actually great at outlining the risks. It's very clear. A 20% drop in ETH could mean a 30 to 40% drop in BMNR. Fast.
And the technicals show it's likely entering overbought territory.
That's the core conflict then. The material leads with this very aggressive verdict. Buy accumulate on dips.
Right, before it really dives into those risks in the overbought conditions.
And that sequencing, it feels like it's encouraging FOMO. It feels reactive, especially after a 19% run-up. The analysis itself is disciplined, but the way the recommendation is presented feels almost impulsive.
The structure needs to mirror the discipline of the analysis. So the recommendation is to resequence that final conclusion. Use the short-term danger as the reason for the specific buy the dip strategy.
But is there a risk that starting with the danger could scare off investors who are just chasing momentum? How do you strike that balance?
I think you strike it by building credibility. You acknowledge the danger not to scare them, but to show that you understand the mechanics of what just happened with that 19% candle. The strategy should be presented as the precise, surgical answer to the risks you've already identified.
Okay, so revise the flow, start the conclusion by nodding to the immediate situation.
Exactly. Instead of a blanket verdict up front, start by acknowledging the short-term risk. Mention the 19% candle. Mention the overbought RSI. You're telling the reader, we see the momentum, and we're not emotional about it.
That builds the credibility you need to then recommend patience.
Then you introduce the buy the dip strategy. You mention the entry points, $28.50 to $30.00, as the direct solution to mitigating that 30 to 40% downside risk.
And you link it back to the technical floor, right? The report already identified $26 as the new support.
You link it directly. By recommending entry points just above that floor, you're positioning the buyer in a zone of strategic strength. It reinforces the non-emotional nature of the entire analysis.
So it completely changes the final message. It's not, it's volatile, but buy it anyway. It's volatile, and here is the low-risk entry zone to manage that, which is supported by our analysis.
Precisely. That sequencing shift is crucial. It elevates the advice and makes the whole thing feel more deliberate and, well, institutional.
This is an excellent analysis. Really, the core data especially is so well researched. So to summarize our key points.
First, integrate an FCF PE or another operational metric next to that 1.94 PE to really solidify the quality of earnings and establish a stable floor value for the company.
Second, to validate that crucial undervaluation claim, you have to insert a specific comparative data point, and using the price-to-book metric is probably the smartest way to do it.
And finally, restructure that conclusion. Lead with the acknowledged short-term risk and the overbought conditions, then position the buy the dip strategy as the calculated surgical answer to that volatility.
The use of specific holdings, like the 3.6 million ETH and those price targets of $47 to $60, that provides such a robust foundation. Making these structural changes will take this from a really strong piece of market commentary to a truly airtight investment thesis.
And please do send the revised material back to us when you're ready. We'd be keen to see how these changes have strengthened your work.